Hello, good afternoon, and thank you very much for joining us for the last webinar in our Rated by Kepler series. I'm Joe Litchow from Kepler Trust Intelligence, and today we're going to be turning our attention to the world of the Asia-Pacific smaller companies. And in just a moment, we'll be hearing from Gabriel Sachs, Investment Director on the Global Emerging Markets Equity Team at Aberdeen, and also Lead Manager on the Aberdeen Asia Focus Trust. Before I hand over, just a quick word on what to expect. Gabriel's going to be talking for around 20 to 30 minutes or so, just sharing a bit of an update on the trust. And after that, we'll move into a live Q&A session where we'll aim to cover as many of your questions as possible. So if you do have any burning questions now, or if anything comes to mind during the presentation, whether it's about the trust itself or broader market environment, please just drop them into the Q&A box in the bottom right hand of your screen and we'll get to them at the end. With that said, Gabriel, it's an absolute pleasure to have you with us today. Over to you.
Thank you, Joe. Thanks everyone for joining. I know it's a hot day in London and the UK, so thank you for your time. As Joe said, my name is Gabriel. I'm the lead manager in Aberdeen Asia Focus, which is really looking for the best quality companies in the smaller end of the investable universe in Asia. It excludes Japan and excludes Australia. Now, I think that the focus on smaller rather than small is important just to set the context. Given I think in the UK there is a bit at the moment a stigma against smaller companies. Small caps have underperformed in many equity or in many regions of the world, but actually Asian smaller companies have done very well. And when we talk about smaller companies, the definition has over time changed. And with markets going up, we feel that the bottom 15, 20% of the investable universe is where we should focus our attention, which is around 10 billion US dollars in market cap today. So these are not speculative small caps. These are well-established businesses. To give you a sense, Aberdeen itself is just rejoined the FTSE 100, and it has 5 billion US dollar market cap. So a lot of the companies in our portfolio would actually make it to the FTSE 250 and FTSE 100. Again, it's more on the smaller end of a very large region of the world where you have some companies now approaching or past $1 trillion in market cap. So we have a very wide playing field to pick stocks. And the trust, just as a brief introduction, has a 30-year history, always been managed by Aberdeen. Over that time period, you can see on the chart on the right that it has delivered very handsome returns, about 12 to 13% NAV return per annum since inception. That does put it among the top trusts in the AIC's ISA Millionaire list. It's actually number 5 there, behind a couple of the tech trusts and a couple of the private equity trusts. So, I think we like to show these ISA Millionaire stamps here, which I think would have made you a double millionaire if you had invested all your ISA pot into Asia Focus over the years. I'll try not to be too promotional, but I think it's worth saying that I think that the asset class has been a strong asset class over the years. In terms of our approach, we've always focused on what we call quality companies. We can go into more detail on this in the Q&A if there's interest. Every company we meet, and we're leveraging a very large team of 35 people in Asia, analysts and portfolio managers, but across emerging markets, we have 50 people. And we're meeting companies day in, day out. Last year we did 2,200 company visits. It's about 8 company visits per working day. And, it's a very bottom-up process where we're focused on, understanding the people, the strategy behind businesses. And I think that's relevant in the world of AI and more quant-driven strategies. We're trying to implement more and more quant tools to our process to help us, which we can talk about as well. But, the fundamental research is still driven and starts with company visits. And we rate each company we invest out of 5 based on 5, each of the 5 characteristics I'm going to talk about, we rate. That includes the industry. So whether it's an attractive industry to invest in, what's the competitive dynamics, the growth in that industry. Secondly, which I think is the most important, is the business model and the barriers to entry for the particular company that you're looking at. Then we also score management and ESG, which are linked in my view. And finally, financial strength of the company with regard to the balance sheet the profitability, and other financial metrics. So you can see on the right-hand chart that the portfolio has a pretty solid position. Asia focus is the dark blue or even black line here, where in terms of the balance sheet, the portfolio sits net cash position and has superior ROE or profitability than both the large cap and the small cap index. Interestingly, the net debt to equity in the large cap index has been coming down. It's actually quite similar to the large cap index today. But I won't spend too much more time on this. I think in terms of why Asia smaller companies, I think it's a really large universe of stocks is the first thing to say. The region has a lot of growth, and you have over the years seen outperformance from small cap versus large cap. I'll have a slide to show on this later. And also in terms of diversification benefits, we're seeing huge concentration in markets. We were talking about the concentration in the US with the Mag 7. That's starting to become, wouldn't say an issue, but it is there's very high concentration in Asia and emerging markets today. And also as a result, diversifying within Asia can actually bring your overall risk down. And I'll draw these points out in a little bit more detail very briefly. I think on this slide here, in terms of the outperformance potential, on the right-hand side, you see the comparison of Asia small caps and Asia large caps. And every year, pretty much except 2021, you see greater dispersion of returns in small cap than you do large caps. And there is that small cap effect where these businesses can grow faster, as long as you're picking the right ones, of course. And on the left-hand side, there's more inefficiency within the small and mid-cap market in Asia. Things like MiFID research in the smaller end of the market has actually got worse, in my view, in my career. And you can see that, within the index, the small cap names, there's about a third of companies have less than 5 analysts covering it. About 15% have less than 1 analyst covering it. And that's not the case in large cap. There'll be 20, 30 analysts covering a Samsung, a TSMC, a Tencent. So the ability to find something new and add value as an analyst is harder. I would say it's not impossible, of course, and these are great businesses to own. But active management, I think, in small cap is very important. And I would also say that within our portfolio, we focus a lot on companies that are not even on the MSCI Asia ex-Japan small cap index. So a lot of our portfolio is not in any of these indices. They're in more local indices, and they're therefore off benchmark positions. And there, the coverage can be even worse. I think on the diversification point, this slide is a little bit out of date. It's a slide from the end of the first quarter of this year. But given how strong some of the tech names have been in the supply chain in Asia, 3 stocks are now actually 30% of the index. So you see TSMC, if we include Samsung and Hynix, that's now 30% of the MSCI Asia ex-Japan index. So huge concentration. And those stocks are great businesses, but they'll be also held in lots of global portfolios. So I think to get deeper and broader access to Asia, I think Asia Focus and the trust we're talking about does offer a nice proposition. And there are not that many trusts out there covering this space, right? I think there's much more large cap trusts. So I think we are quite differentiated, and we provide differentiated exposure versus large cap, not just at the stock level, but at the country and sector level, because the makeup of the index and the universe is different as well. We can talk more about that later. But if you look at the index, the small cap index, there's 1,560 odd companies. Again, that's a limited universe compared to what is actually out there. So just the A-share market in small and mid caps would be much larger than this. And we have about 60 holdings, 50 to 60 holdings in the portfolio, so relatively concentrated and high conviction. And the active share versus our closest benchmark is 95% plus. So again, we're very different to any benchmark, both large cap and small cap. So I think here in terms of why consider it, and this is the evidence, I would say, to what I've been talking about in terms of how Asia Focus has performed from a risk versus and return basis versus a passive allocation to Asia large cap. So, if you define risk as volatility, some people might disagree that that's the best definition of risk. But at the moment, if you bought Asia Focus, you would add a little bit of risk in terms of volatility, but you really enhance returns. This is since inception. But the passive allocation to Asia would have returned 500%. Asia Focus over 3,000%. And so, the way I normally pitch Asia Focus is actually as a complement to large cap, because in practice, a lot of people will want to have exposure to large cap. But I think combining that large cap exposure with a trust like ours, I think is quite helpful from a risk return point of view. In terms of country positioning for the portfolio, we like to be diversified. So that's the first thing to say. We don't want to put all our eggs in one basket. The right-hand charts are showing our relative position to the benchmark. But from an absolute point of view, on the left-hand column, I'd say we can split this in 4 buckets, which is India in one bucket, China, including Hong Kong, another bucket, Southeast Asia is another bucket, and then the more tech export-oriented countries, which is Taiwan and Korea, as the 4th bucket. And those, a year ago, those buckets were quite evenly spread, about a quarter in each. At the moment, we have the highest allocation we've ever had to Taiwan and Korea. That is, this is at the end of March, but it's actually increased a little bit to 35 to 40% of the portfolio. So that's at the high end, and we've been taking quite a lot of profit from tech and AI, which is why you see an underweight building, particularly towards Taiwan. The underweight to Korea has actually shrunk, and we have good stock selection there. But our underweight to Taiwan is probably about 8% at the moment, but we still have a very chunky allocation to Taiwan, given we are seeing very strong earnings growth coming from the supply chain in tech, which we can talk about in more detail later. But essentially, those 4 buckets give us very different structural drivers and themes and companies to invest in. India and Southeast Asia are more domestic oriented. Southeast Asia is the more value oriented part of the universe. You can pick up some very cheap stocks there, but it is a mixed bag in terms of countries, and it is very fragmented. Our largest allocation in Southeast Asia is actually Vietnam, where we have a fully off benchmark position of about 5 to 6% in 3 stocks. We feel quite good about Vietnam. I think it's one area that we could see a higher allocation in the next few months. We're doing quite a lot of due diligence on stocks there, and I think the valuations are very cheap for the growth on offer. And then, of course, China and India have their own idiosyncrasies, which we can talk about. China being more for us on the industrial automation side, new consumption trends, but also some single stocks in different areas like healthcare, materials, and also industrials. So that's probably enough on the country position. I think sector-wise, this is really more makeup driven by our bottom-up stock selection. So tech has become an underweight, given we've been taking profit. We've also been exiting some IT services and software names over the last couple of years, but we still have our decent chunk in tech. And I would say that some of the supply chain in tech and AI comes through in other sectors like industrials as well. But those 2 sectors are the largest in the small cap universe and the largest for us, although it's industrials is closely followed by financials, consumer discretionary as well. And we have quite a lot of diversified exposures to things like consumer, to healthcare, and even real estate. So it is a very diversified portfolio, and we like it that way. And on this slide, we cover a little bit around some of the tailwinds from a structural growth point of view. I probably won't spend too much time on this, but it's always nice to bring some examples to life of things that we're investing in. At the end of the day, it is all about the companies for us and the individual outlook for them. So we do capture the classic domestic growth story and aspiring middle class story in the region, and we'll talk about one of the stocks there called 361, which is a wealth manager in India. We have a decent exposure, as I said, to tech innovation, particularly the AI supply chain, but also different parts of the tech landscape. Energy transition is becoming an important theme where Asia has a pivotal role to play, given quite a lot of investment from the Chinese, from the Koreans in electric vehicles, in solar and wind. Also, the Koreans have very strong position in engines, which are going into ships, or sort of greener vessels, and the Koreans in general, in terms of heavy industry, have been investing in things that are in demand at the moment, with regard to the rising capex, which you see with countries looking to improve their resilience, energy security, etc. And also on the health and beauty side, we have exposure there. And again, it's sort of a derivative play on the rise of incomes of the aspiring middle class. So to give you a couple of examples of stocks, and I focused on a couple of stocks that are not AI driven. I think everyone might be a little bit bored about hearing about AI. It's been quite a narrow rally year to date. We've had extremely strong performance coming from our Taiwan stocks, not just over the past year, but over the last 4 or 5 years. Our two key holdings in Taiwan have been 10 baggers for us. But we're starting to look elsewhere. We already have a very diversified portfolio. So to give you a little bit of a flavor on that is 361. WAM still stands for wealth and asset management. This is the leading company within the ultra high net worth individuals in India. So you'd compare them to some of the Swiss banks like Julius Baer, who actually have a presence in India, but have been losing share, and they're very small. So these guys, it's hard to estimate market share, but in terms of new money, or when promoters sell stakes in businesses, typically 20% of wealth is going to these guys to manage, and they have a very interesting advisory model with recurring revenue streams. So it's not what you'd imagine in terms of investment banking, cyclical earnings. Obviously, there's an element of cyclicality to the business, but they do make a very recurring income stream on the assets under administration on the wealth side. And then they also have a smaller asset management business. The asset management industry in India, to my knowledge, is the fastest growing asset management industry anywhere in the world. It's been growing incredibly fast. So these guys have been growing at 20 to 30% rates per year. I think we have the earnings CAGR here on this slide from 2021 to 25, 29% earnings CAGR. The company is very efficient, have very good profitability. They also have a strong position in alternative assets, which is a growing area in India. And so this is a play on middle class income growth in India, particularly at the higher level, I suppose, where we think barriers to entry are higher than the mass market. There is ways to play the mass market as well in financials and capital markets, but we like 361, and actually UBS have just taken a 5% stake in this business. They've sold their local wealth business to 360. The multinationals have been struggling a lot in India, and now they have a referral scheme where any UBS clients that want to invest in India as an Indian national will go through 360, and any Indian national that wants to invest offshore, they refer to UBS. And it's quite likely that UBS eventually will start to increase their stake as a strategic investor in this company, although the idea is that they remain independent. That's probably too much detail on this one stock, but the next one is Mobile World in Vietnam. It's the largest position in the country at about 2.5 to 3%. This is a retailer. It's the largest retailer in the country. Historically, their model was more around consumer electronics and smartphones, so a bit like a Best Buy, or let's say a Currys here in the UK, which I think in the Western sense is a bit more of a traditional, old school, maybe saturated model. And they're not growing that business anymore, but they're still delivering very good growth from a same store sales point of view. But the key excitement here is around groceries retailing. So they're rolling out supermarkets with a lot of fresh food, which is replacing the traditional informal wet markets that you get in Asia, and Vietnam is quite prevalent. So these guys are starting. They already have a very wide store network, but it's all about a penetration story. So penetration of formal retail in Vietnam and groceries is still, in the teens. So there's a multi-decade opportunity for them to grow supermarkets in Vietnam. So it's a very exciting business, grows quite strongly. It's pretty cheap. I think the forward multiple has come down from when this slide was made. So it's teens PE with a very strong profitability, very strong management. So it's another company we quite like. In terms of overall portfolio characteristics, I think a few things to call out here. We've already mentioned the strong balance sheet, net cash balance sheet, strong ROE, the valuations on a forward-looking basis for this year, slightly above the benchmark, but on 17 times, given the growth on offer. Doesn't seem too bad. It's probably a little bit higher than historical averages for Asia small cap. I think markets like India on the more expensive side, and also I would say Taiwan on a headline multiple basis is on the more expensive side. Although if you put it on a PEG ratio, and if you believe the earnings coming through, Taiwan is actually the cheapest market in Asia. Obviously, the earnings at this level of growth might not be sustainable, but the earnings are coming in extremely strongly and beating already higher expectations in the market. And we can talk more about that if there's interest in the Q&A. A few things to mention. We have gearing in the trust at about 6% at the moment. We want to keep structural gearing in place. We did reduce it very slightly at the end of last year. We had made very good returns, both in absolute and relative basis. I think there might be a little bit of complacency in markets, and because we rotated some of the convertible debt that we had, structural debt, into rolling variable debt, we thought that for that portion of the debt, we could use it a little bit more tactically. We don't want to call markets. We can't call markets, but we thought we could take a little bit off and increase the gearing at a more opportune time in terms of valuations. Again, we can talk more about that if there's interest. The discount's still hovering around 10%, which we think offers good value. The board have been doing quite a lot of buybacks over the last year. Although that was concentrated in 2025, I think in 2026, the buybacks have slowed considerably, and the discount has steadied around that 10% level. We have a progressive dividend policy. This is not an income fund, but we can pay our dividends all out of the income coming from the companies, and the board have committed to make that dividend progressive, so that the trust is attractive both from a growth and an income point of view. Historically, the strategy has been quite defensive, but I think in the last 3-5 years, we've actually captured a lot of the upside in markets as well, which I think has been a little bit by design. We, historically might have been a little bit too defensive, I would say, with a low beta, but our beta has ticked up a little bit to 0.9, and with typically a 10% gearing that we've had, that has given us enough opportunity to perform, and even in rising markets and strong momentum markets. And the other thing to say would be the gearing has added about 1 to 1.5% return to NAV per annum over the last 5 years. And I guess just to finish on near-term performance, we've had a good period of performance. So for the year ending at the end of May, the share price has risen almost 50%. Given there has been some narrowing of the discount, that's ahead of the NAV, which rose 42%, well ahead of the benchmark. And over 5 years, we have a conditional tender in place that the board put in place almost 5 years ago. That comes to an end on the 1st of August. But as you can see on the bottom right there, in terms of the 5-year performance, the NAV is up around 88%. The benchmark up about 58%. So the conditional tender offer is unlikely to result in a tender unless something really crazy happens in July. But in June, we've also been performing ahead of the benchmark. So I think we're happy with performance. We can always do better. There are things that we're trying to improve, but I think we've been cycling through a good period of performance. And it's quite likely, it's not confirmed, of course, but that the conditional tender offer would roll over and there'd be another one, but I can't say that for sure because it hasn't been discussed at the board level. So I'll probably stop there. I think I did spend about 25 minutes, which is longer than I intended on this bit. So Joe, let me know if there's any questions.
Fantastic. Thank you, Gabriel. No, I think that's a really nice round of the trust, how you're positioned and kind of why you're standing out in the smaller company space. So thank you very much for that. Yeah, a few questions I think we can just crack on with. I guess one of the big stories in the kind of Asia Pac region is Vietnam, given its pending promotion later this year to EM status. But obviously, it's one of your largest active overweights. A couple of questions, so I'll throw them at you at once, but we can split them into two. I guess, given its strong run, particularly over last year, how are you thinking about the opportunity set now? Are you trimming? And given the EM promotion, it would be good to get your thoughts on what that actually means for the investment case. Do we know what the weight will be in the benchmark? And I guess in that situation, when it does hopefully promote itself to EM status, are you still, you and the team still thinking an overweight position is a good place to be?
Great. Yeah, thank you for the question. So just on the upgrade this year is with FTSE, which is relevant, but is typically not as popular. I will use that word. I don't know if that's the right word to use. It's not as popular as the index provider with a lot of managers. So I think MSCI typically matters more, and that comes normally a couple of years after FTSE. Interestingly, they didn't include Vietnam. MSCI didn't include Vietnam in the next consultation process, but I think it's just a matter of time before Vietnam gets upgraded in MSCI as well. So I think the direction of travel is positive. I think we have in place a very reformist oriented government. So there was a change in government relatively recently. They're making quite a lot of changes, which from a business point of view is positive. And that should also improve some of the issues in Vietnam with regard to accessibility, liquidity, etc., which have plagued the market to an extent. I think we actually had about 7% overweight to Vietnam before Liberation Day. We took that down a little bit because Vietnam was a little bit more exposed to tariffs in terms of their trade position versus the US. And we had made very, very strong returns from a company called FPT. So we really reduced that stock and we exited a property developer, which we quite liked, but we thought was the weakest conviction within our holdings. But after Liberation Day, there was a correction in the market. We started adding back. Before Liberation Day, we had added a bank, and we've been building Mobile World as well. And I think we have two or three stocks that we are eyeing at the moment. So I think the weight will go up. And we think the valuations for those stocks are very cheap, if not getting cheaper. I think the situation in Iran has spooked a few investors around Southeast Asia more generally, but that might be changing. It might be a little bit different. What I describe as the performance of Vietnam versus Vietnam only trusts, because I think on a country level, a lot of the index will be banks, will be property companies, and will be Vinhomes or the Vin Group, which we don't have. So we are quite selective, and because it's also not on our benchmark, we would really need to worry about some of those bigger groups. We focus more on best ideas in Vietnam. But the market, I think, has been doing all right. It's added value to us over the last 3 to 5 years, and I think will remain overweight for the time being, especially as MSCI is not going to upgrade it likely in the next couple of years.
Great. And just kind of teetering off a little bit, Gabriel, on what you said about the conflict in the Middle East, naturally there's a huge amount of dialogue on what that means in the broader region. So it would be good to get an idea. I know you guys are bottom-up investors first and foremost, but have there been any changes to the portfolio, I guess, in light of the higher energy costs post kind of the Iran war, or is it very much business as usual? The portfolio is insulated in parts.
Yeah, that's a very good question, and we are driven bottom up, but we do have portfolio construction level. We do think about weight, position sizing, and country sizing in particular from a top-down perspective as well. We do want to outperform our benchmark, and therefore we need to have a good reason to be under overweight a particular country, sector, or stock. So we do look at the benchmark and we think about the macro political risks as well. So one of the things we were doing at the end of last year, we were taking a lot of profit from tech and AI, given the run that we've had. And we were conscious that was a little bit early, perhaps, but we were seeing a lot of value in Southeast Asia. I think Iran complicated that a little bit in the short term because Southeast Asia is the most exposed even India in terms of the currency import dependence on oil. And I think countries like Philippines and Thailand, for example, look quite vulnerable. I'd say Philippines probably the most. That's not a big part of our portfolio, but we fortunately actually had a stock that was acquired, taken private, and we sold in January in the Philippines. But we put a bit of a pause on adding to Southeast Asia uh, and India, and actually we probably reduced Indonesia over the last 6 months or so. We think that the politics there is quite is moving in the wrong direction. So even though it's a small location, the valuations are very cheap. We were sitting on an overweight in Indonesia, so we've actually brought that down slightly. We can talk more about Indonesia, but I think obviously that's a more near-term issue. I think taking a longer-term perspective, we don't think that this is a big problem for companies in the region. But yes, selectively in some countries like the Philippines, inflation has already spiked, and that will cause a little bit of an earnings drag for the next 6 to 12 months potentially.
Fantastic. And maybe a bit more specific now on some of the holdings. I think it was on slide 10, the portfolio positioning tailwind slide. Within the energy transition bucket, you've also got a couple of stocks there, Korea Shipbuilding and Hyundai Electric, as key beneficiaries to the clean energy transition. I wonder, Gabriel, if you could delve in a little bit to that, why those companies specifically are well placed to benefit, and perhaps what the theme brings to kind of the longer term opportunity from here.
Yes, absolutely. So we actually have three holdings within the Hyundai group now, which sort of happened independently. But I was in Korea last week, so I met a couple of them, and the thesis is really around the upcycle in capex that we're seeing globally. So it's not necessarily a Korean story, but also a European or particularly in the US story where there is requirements for renewal of grids, given different energy sources and generation, infrastructure. In places like the UK, for example, sometimes are dated. You saw things like airport blackouts and things like that, and that's linked to transformers and the need and the constraints on power these days, which AI is only making worse. So a company like Hyundai Electric makes transformers, which they have, facilities in the US, and they have quite a lot of market share in the US. They're probably a tier two player to guys like Siemens, but they have capacity and they're growing very strongly. So that's a business we've liked. It has done very well for us already. To be frank, it's more of a large cap now, but it's still a theme that or a company that's seeing very strong orders, good pricing coming through, and that's still a tailwind for earnings. On the other side, we have a bit of exposure to shipbuilding, which is at the industry level more of a cyclical industry and perhaps a lower quality industry. But after a period where the shipbuilders have had a very tough time, the Koreans have actually been investing in innovation in greener vessels and in greener, more efficient engines, and that all falls within this conglomerate called KSOE, or Korea Shipbuilding and Offshore Engineering. So it captures the energy, the engine side, it captures the shipbuilding, and it also captures an aftermarket service business, which we invested in at IPO called Hyundai Marine Solution, which is very nice business because it's asset light and they have a captive market in serving all the Hyundai engines and ships. And that's been growing again very, very steadily. They're now entering interesting areas, which some people have been skeptical about, but they were saying last week that they're starting to see orders already in the second half of this year around floating data centers and also helping to service engines that will be used for AI data centers, because essentially we have a lot of constraints, physical constraints on AI now around power. So sorry, that was a very long-winded way of saying, these companies play into parts of the energy transition theme, but there's obviously other sub-industries that we can buy in China or in other markets as well.
Fantastic. And just I guess one more thing, perhaps on how the portfolio is positioned. Appreciate it is, I think, the only holding in the portfolio, but you've got some exposure to the UK through MP Evans. I think that's the only UK stock in the portfolio at the moment. But maybe talk to us why you've got exposure in the UK of all places for an Asia Pac fund.
Yes. I do get questions about this a lot, and it's probably the only stock that most people will be familiar with in the portfolio. So yeah, that is MP Evans. It's actually one of the longest holdings in the trust. We've, I think, pretty much held that since inception. It was before
Okay.
my time, but certainly over 25 years, we've been invested in MP Evans. They are, they have a small office in Tunbridge Wells, but all their operations are in Indonesia, and they've been executing phenomenally well in terms of just conservative and gradual growth. The palm oil industry, palm is the highest yielding
Yeah.
um, vegetable oil out there. Uh, and it also has support and demand from biofuels in the region. So with the Iran war and concerns around oil prices, that actually is supportive for palm. Uh, but it's just a business that's been executing very well. It's still
Yeah.
relatively cheap, offers a good yield, and so we've kept it. It's a little bit outside of our remit as far as the listing is concerned. But as long as the operations are in Asia, we feel that it is in the spirit of the fund. So we wouldn't be averse to investing in another UK business if all its assets or revenues are in Asia.
Brilliant. And Gabriel, you touched on it at the beginning of the presentation, on kind of problems within India, and obviously you're active underweight. But we've seen India face some pretty difficult times over the last 12 to 18 months, with tariffs, rupee weakness, earnings growth slowing beyond what it was before. And valuations have come off a little bit, but I think still are arguably, priced pretty high. But I guess from your perspective in the smaller company sphere and your active underweight, what do you and the team really need to see from India in order to consider a bit more exposure there?
Yeah, look, to be frank, I wasn't necessarily thinking India would be a priority market for us this year,
Yeah.
but we are seeing opportunities. So I think, I might have said that we're not adding to India 2 or 3 weeks ago, but then something comes up, and we actually have invested in a company, pharma company, where uh, the PE firm has offloaded some stakes. We tried to participate in IPO. It was a very hot IPO. It's a small company, but we added 1% in that company in India, uh, and we've also had good performance from a couple of others. So India has actually crept up to about
Okay.
20% of the portfolio. I think what we need to see is really have the confidence that the earnings are going to meet or beat expectations. I think India had a very good run in 2024. Uh, Valuations were quite high and expectations were quite high. So our concern was, whether companies would meet those expectations. And broadly speaking, they've been a bit mixed. So that hasn't given us the confidence to uh, add too much to India. So we let the weight of India drift, waiting for better opportunities because it's lagged. We're waiting for better opportunities to add. I think we're getting closer there, and I think because it's such a deep market in the small and mid cap space, I'm sure we'll find opportunities. But in some cases, we have been recycling
Okay.
existing holdings where we think the valuation is quite full. So I think India is still going to be a very important part of the portfolio, and also helps to diversify what has become, a big part of the portfolio in tech as well, in Korea, Taiwan.
And I guess a little bit further east from India, with China, it had such a strong run over 2025. That's obviously peeled off a little bit, and I know we saw some data, domestic data, not too long ago on a bit of a weaker consumption and a bit of concern around the property space still lingering. But obviously, there's a lot of hype around its importance, and the 5-year plan impact as well. But it'd be good to get a bit of an insight to what you and the team are seeing, whether it's on the ground or whether just discussions on areas that you think are actually holding up better than headlines are suggesting, or areas that are genuinely cause for concern.
Yeah, I think the economy has been a little bit weak, and
Mm.
consumer hasn't been doing well. Property market hasn't quite found a bottom yet, and that's proving to be a big drag for a big
Yeah.
part of the Chinese economy. So we still have some consumer stocks in the portfolio, mostly geared towards new consumption trends, where we think things are coming off a lower base, and
Mhm.
there's emerging brands in areas like pet foods, travel, where demand and spending is still going. but certainly it is a mixed picture. I think the areas that China are doing well is what you highlighted around, um, the impetus to to innovate, to become leaders in advanced manufacturing. Things like robotics. China is ahead, I think, of the US and most countries. Thousands of robotics companies. Some of them, this might feel like we're very far away from actually getting a humanoid robot, but actually, just in terms of just automation and more traditional robots that are not necessarily trying to mimic what we do, China is already really well placed, partly because they need to, from a demographic point of view, to to to, to automate essentially. So we play into that story. There's a lot of interesting companies in that space. Electric vehicles, we all know how China has become such a large exporter from nowhere, and you'll be in Korea. A few years ago, the battery makers were all Korean, LG Chem, Samsung SDI, and that's all now shifted to CATL, which has become the Korea leader. And you could see that with parts of the AI supply chain as well. So when I was in Korea, there was these inspection companies for semiconductors, which had 30-40% exposure to China. But because of the drive from China to localize, they've lost all their business in China, and they've already found companies that maybe can't do quite as good the tech as Korea. They are catching up very fast. So I wouldn't put it past China to over time, this is multiple years, start to encroach on the memory space from the likes of Samsung and Hynix, which are obviously now got a lot of pricing power and are seeing a lot of demand for high bandwidth memory chips.
Okay, fantastic, Gabriel. I think we've got time to shoehorn one more question in, and it's I think a nice one to wrap things up. But I guess for a UK investor, perhaps who already has exposure to mainstream emerging markets, what would you say AAS has to offer that a broader emerging market fund doesn't? And why does the smaller companies angle in particular matter in Asia so much?
Yeah, so I think I work in the emerging markets team as well. So I think
Yeah.
having the way I think about equity investing is to be globally diversified. So I think some of these uh, labels that MSCI or other index providers put around asset classes are a bit artificial. Korea has nothing to do with the Brazil, but they bunch it together as an emerging market. So I think there's value in being diversified. Um, and at the moment, whether it's an Asia Pac or an EM portfolio, 40% of the portfolio is in a handful of stocks that are also in global and tech portfolios. So I think you're not getting the diversification that you think you're getting. And even within an EM, yes, you'll get lots of broad exposure, but it'll be more at the tail of the portfolio. Whereas I think with something like Asia Focus, you have high conviction positions, 50 stocks at around 2.5% each, or 2% each, sorry, which gives you access to small and mid caps, which are really driving growth in the region, right? So I think TSMC is obviously driving growth globally, as is Samsung, but I think there's lots of businesses that are the backbone of domestic economies and of things like AI supply chain, which are not captured in many people's portfolios. So I think that's what it offers. But and I'd come back to this slide in terms of the risk return opportunity. But yeah, having exposure to broader EM is also, I think, valid. I think I'm Brazilian by background, and I asked to move to Asia for a few years because, from my perspective, I think Asia has the clearer structural growth story.
Yeah.
We might disagree with how governments are run in places like China, but there's a strategic plan, and they execute quite well, and that provides a lot of opportunities for growth. Whereas I think in Latin America, there's a lot of opportunities, great companies, but it is a little bit more cyclical around election cycles, and so that's a little bit disappointing from my perspective. But I still think it's worth an allocation, and I certainly wouldn't say that you shouldn't allocate to EM and allocate to Asia instead. I think you can have a bit of both.
Brilliant. Well, Gabriel, I think that's a really nice roundup actually of not only just how the trust is differentiated in the sector and how it's positioned currently, but also some really interesting insights, I think, on what's happening in the broader market and perhaps why Asia Pac is a place to look at the moment. So yes, thank you so much, guys, for submitting the questions that you did. Very helpful as always. And any of those still on the call or listening to the recording that want to explore the trust in a bit more detail, then it's worth noting that Gabriel and the team at Aberdeen publish a really wide range of materials on their website, both on the trust specific updates, but also broader market insights. So I'd encourage you to go and have a look at that. Gabriel, just before we wrap up, a big thank you to you for joining us on today's webinar. I appreciate conditions are a bit strenuous with the heat, but it's been a pleasure to have you on today's webinar.
Thank you. Pleasure to be on, and have a nice day, everyone.
Well, that does bring us to the end of today's session and to the end of our webinar series, this Rated by Kepler series. So thank you all for attending, and just a note to say that all of the replays will be on our website soon, so you can go back and watch any of those again. Have a great weekend when it comes, and take care. Goodbye for now.